Good morning and hello, YouTube friends. Welcome to another episode of The Rational Investor. My name is Adam Kahn. Today is December 16th, Saturday. I hope you're all doing well. I hope you're enjoying your weekend. I'm going to talk about why I sold JEPI, JEPQ, and TSLY. And if you're interested why and you want to understand it, stick around for this video. I'm kind of excited to explain it. So before I get into the reasons as to why I sold JEPI, JEPQ, and TSLY, and any other call covered strategy ETF, if you haven't already, do me a favor, give a thumbs up and hit the like button. Also, if you haven't yet subscribed to the channel, do me a favor, subscribe to the channel. Both of those things help YouTube's algorithm and other people find the channel. I really appreciate the support. It's really the goal, and I love it. I want to thank you guys who signed up and everything else. So why did I sell these funds? The real reason is you have full exposure to the downside with limiting your upside. So unless you're at really the later stages in life and you need that income coming in, there's a lot more risk to these funds than I think a lot of people investing them recognize. And forgive me, those of you who don't know my background, I was a commodities trader for a long time. TSLY actually made me realize that there's probably good opportunity in a call selling strategy, but I don't want to own a synthetically long stock just to have extra risk and then buy a small amount of treasuries against it and then sell calls and limit my upside. Personally, I'd rather be long the stock and sell calls. Like, that's just how I would do it. And I think weekly options are a good opportunity to do this. So I started doing that. And to be perfectly blunt, I've crushed it. So I don't see a problem with the strategy. I see a problem with the fund managers and my lack of trust in them. And I also see a problem that I don't know that the people investing in it really understand. I'm sure some of you do, but I'm sure a lot of people, and I would guess the bulk of people, really don't. And they're overly attracted to a high yield and don't recognize that the companies are taking full downside risk. So if Tesla goes lower, or in JEPQ, the Nasdaq, or JEPI, I think they're using the S&P 500, but it might be a different amalgamation of something. That if those stocks go lower, you're long the full amount as if you were long the stock. Sure, in TSLY's situation, 20% as a maximum goes to buying U.S. equities at a 5% return to, not equities, U.S. Treasuries at a 5% return, which is actually going lower to offset a little of it. But if Tesla falls 20% in a week, the value of TSLY is going to go down 20%, less whatever they've made up in the being short the calls against their position. So I'm totally comfortable with that risk. I just would rather have the calls myself where I can choose where I want to sell them and where I'd be happy getting out of the stock. Like, to be fair, if Tesla keeps going higher, those investing in TSLY aren't going to see any risk with it, and they're going to get some sort of return on the investment. And supposedly the fund should actually creep up in value as well. In terms of JEPI or JEPQ, I'm much more comfortable being longer a Best Buy or a Cracker Barrel or whatever else and selling calls myself that are much longer term to maximize the return or the yield in terms of the stock that I own, the underlying stock. Now, please, this is not financial advice. You guys need to do your own research for what works for you and your financial decisions. I'm just sharing what works for me. I hope you look at it as entertainment purposes. I hope you find the content interesting, but don't follow me. I'm just a guy on YouTube. And to be perfectly blunt, you shouldn't be following any of us. And God forbid, don't be following Miss Mary, or whoever it is that's promising, 100% returns in a week. Now, I have a retirement fund that this year is up over 100%. I'd be happy to share it. But so you understand, that's just dumb luck of it's a small investment to me. I opened up a new Roth IRA and I had no issue kind of dumping 100% of the investment in one stock one year. And then I expanded to two, and those happen to have a good year this year. That doesn't mean that somebody should be out there touting absurd returns in an unreasonable amount of time and how other people can do that as well. The real basics of investing is the higher the return, the more risk that is being taken on. Really is that simple. So anybody who's offering to double your money or get 10% returns a week or whatever it is, they really have to be taking more risk in order to give that return. That is the same with Tesla. There is no guarantee. Same with something like a Cornerstone. If it's paying a 20% dividend right now, something's going on that either they're taking more risk or they're sending out more cash flow than's really coming in and taking on debt to get there. There are some examples, and I haven't dug into Cornerstone that deeply. So those of you who know better, I'm fine with that too. And you're going to find some diamonds in the rough from time to time where prices get out of whack. And to be perfectly honest, that's where I thought they were before the Fed announced and before a week or two ago, when to me the stock market was too low. There were plenty of good deals out there. At this point, I think it's pretty fairly priced, but I think there were screaming deals that might have lasted a long time. In fact, tomorrow I'm going to talk about the portfolio I opened for you guys. It was a $10,000 portfolio. I opened it about 3 weeks ago. I've been updating it on every Sunday. I actually added on to one of the positions, and I'll talk about it a little bit now today, and I'll talk about it again tomorrow. But it was probably a mistake. I know better. Pfizer's had more bad news. It's been struggling, and I like the dividend, and I see it struggling, so I added on 5 more shares in that account and put in another $100. But I've also learned over the years that a lot of times the things that lag can lag for years and years and years. So maybe it's not the best strategy always to add on to the ones that are doing the worst, because sometimes they're out of favor for a really long time. So I'll explain the strategies of JEPI, JEPQ, and TSLY, and hopefully it helps you understand why I got out of these funds. So for the most part, they do what's called covered calls. A covered call is owning an underlying equity and selling a call against it. Now in JEPI and JEPQ's circumstance, my understanding is they sell at the money calls, and they're usually 1 month out. So what they'll do is, let's say they own a stock that, now they do it with like the Nasdaq 100 or things like that. But to make for explaining purposes, I'm just going to make up a stock. So let's pretend the stock that they're using is an $100 stock. They would then sell a 1 month out call at $100 to get that yield or return. If it's trading at $1, they get $1 on the $100 stock, or 1%. And if they can do that perfectly over 12 months, well, that's good 12% return. The problem is they own the stock at $100. If that stock drops to 90 over the month, well, they've lost that $10. Yes, they've made the dollar on the call that they sold, but next month they are then selling the $90 call against it. They use a lot of stocks, so they're well diversified, and it really shouldn't drop that dramatically in a short amount of time. But to be fair, if there's a real stock market correction, it could. Now, since JEPI and JEPQ sell an at the money call, if this fictitious $100 stock goes higher, well, they're committing to sell that stock and they get the $1. And if it gets to 110, they then sell the 110 call against it and maybe get another dollar. Now, of course, they're getting that 1% return, but they didn't make that $10 that the stock went up. They only got the dollar from the call. So in both examples, they kind of limit themselves. Now, if the Qs, but if our fictitious stock settles between 99 and 101 the next month, well, they've done great in terms of it, but I think that's not going to happen way too often. Now, if you look at what TSLY does, they sell, we'll use one, but I'll use Tesla in this example because I'm familiar with it and I trade it. So they'll sell one put and buy one call to be synthetically long the stock. Let me explain so everybody understands. If you sell a put and the stock goes lower, you're committing to buy the stock at the strike price of Tesla. If you buy the call, you have the right to buy the call or buy the stock at the strike price as well. So Tesla closed around 253, I think. So if they're using the 252 and a halves, if that's an option, They'll sell a 252.5 put. They'll buy a 252.5 call. They're already 50 cents or so in the money on the call, having the right to buy the stock. And if the stock goes lower, they have to commit to buying it. So they're really essentially, which is why it's called synthetically, long Tesla stock. They do this because you don't have to use the 25,000 that the stock would cost. You're able to use a certain percentage of that depending on the relationship with whoever they're clearing. What they then do is they sell a weekly call against that synthetically long Tesla shares, and they also use a certain percentage to buy treasuries to get a small percentage return as well, since they don't have to put up 100% of the capital. Now, similar to JEPI and JEPQ, they're limiting their upside potential growth in the stock. So let's say they decide to sell the 257 or the 260 call. If Tesla skyrockets to 280, well, they've committed to selling that call at whatever, the 260 example I used, and they don't earn those extra $20 a share. They still get to keep whatever they brought in the premium and selling the option, but they've limited their upside. At the same time, if some bad news comes out on Tesla and the stock drops to 200, which to be perfectly honest, I don't really see it doing that in a week. But if that happened, since they're short the put, they've committed to be long the stock and they will lose that full percentage of they'll lose that $50 or so. And maybe they'll sell a lower call. They'll still get to collect the premium from the one they sold, but you're making back $2, $3, $4 in the weekly options. And if it dropped 25 or $50, really you're going to see the TSLY stock itself drop significantly because of that. Well, I don't want to have full downside risk like that with somebody else managing my money. I'm so much more comfortable deciding for myself which calls to sell. And I think it's a good strategy, so I don't want to take away from it too much. I've had great success with it since I started looking at it of doing a similar strategy. I bought 100 shares of Tesla and I sold a call against it, a weekly one. And I started doing this maybe 2 or 3 weeks ago. And then I actually bought another 100 shares and sold a call against it, a weekly one. Now I have two calls for next week, one that's already out of the money in some respects. I'm short, I think, the 252.5, or I'd have to look to confirm call, and it closed a little above that. And I'm also short a 260 call, so I might get taken on all 200 shares, or if the stock goes lower, I'll collect the premium for both. And I've been thrilled. I've been making, maybe $400 or $500 a week on selling the calls, so that's great return on it. And fortunately, the stock has been drifting higher, so I'm actually up. I want to say $2,000 or $3,000 on the stock as well. Now that's not normal returns, and I'll repeat again: this is not financial advice. I don't suggest anybody else doing that. I'm probably used to more risk than most because, I traded yen futures for what I did for my living when I was young, and the swings are pretty significant. So if Tesla falls a little bit, it's not gonna upset me if I'm down a little bit of money for a little while. And like I said, I think the strategy isn't a bad strategy. I'm just not really comfortable with fund managers doing it and taking a percentage, and I don't trust their ability to make those decisions for me. It might work for some of you guys, which is why I say it's not financial advice. This is just what works for me. But I'm not comfortable with Tesla. I think if they're paying 60% returns, they're taking on too much risk. When I'm looking at the return I expect, I would expect 20 or 25%. The way I look at the calls as dividends as well. And I get it. I don't mean to do the quotes like that. Like if I'm doing the strategy, I see some value in it. I just don't love the funds. And I would rather invest the other money, like in a JEPI or JEPQ, in something that pays me a dividend and then sell a 1 year out call that, like I have Stanley Black and Decker, which I was fortunate enough it's rallied from the 80s to almost around $100 a share. Well, I sold an 150 call for a year out and got an extra, I don't know, $1.30, $1.40, somewhere in that range. Well, that's about what their dividend pays. If I pick up one extra dividend for a year, and if the stock goes up 50% in the next year, well, so I'm committing to sell it. And if it went 100% higher and it's at 200 and I lose that extra $50, boy, I'm thrilled to make 50% return in a year anyway. So why wouldn't I take that dividend check? And it's not really a stock I plan to sell. That's how I would rather trade my dividend portfolio, or the things I'm looking for getting yield on, in terms of, like a lot of you, I hope one day I can just live off the dividends. Um, uh, Hopefully I get there sooner than later. And with the trading I do, maybe I could, I don't know. But my real goal is to have passive income. I'm guessing a lot of you look for the same type of things. So anyway, those are all the reasons why I sold JEPI, JEPQ, and TSLY as well. I would rather make those types of decisions myself on the calls to sell and how to use that strategy than trusting a fund. I don't love that JEPI and JEPQ are selling me at the money calls. That's just not what I would do. Um, but I know they get good return. And actually, in the account that I opened, the $10,000 one, I think I have 10 shares or something of JEPI in there, and or JEPQ, and it's actually drifted higher, and I've gotten a dividend check as well. So that's why I say it may work for you guys. It's just not what I want. I see other ways of what I'm more comfortable with. And for TSLY, I sure don't want it, because I don't know what they're really doing. I don't trust that. I'm not comfortable with the positions they may be putting on. So again, at the end of the video, God forbid somebody actually made it this far through boring me, but I like me and I like chatting. Anyway, if you've made it this far, again, thumbs up, subscribe, make some comments. I love the comments. Somebody commented who's from Westchester, New York, which was super cool to me because I grew up there. They haven't responded yet, but I made a comment that I grew up there, kind of digging and asking about it. They had questions about real estate, but I thought it was cool. So a shout out to Westchester, New York. Hope everyone's well. Um, See you tomorrow. Before I forget, tomorrow's one of my favorite videos. I'm going to go over the $10,000 portfolio that I've done. I can't believe how well it's done. Spoiler alert, we're going on 3 weeks. I'm up over 9%, which is like almost comical. It's a diversified account. You shouldn't be able to make that type of return diversifying like that. But I think the Fed announcement, as well as just some luck, is a earnings report for one of them. And just some lucky picks. Anyway, stick around tomorrow as well. Come watch that video. I'm excited to share.